You have likely been told that retiring with debt is a financial failure. Every time you see that mortgage statement, it feels like a weight on your shoulders that should have been gone years ago. But the world has changed. If you are hearing that a mortgage in retirement is always a mistake, you are getting advice that ignores the math of 2026. Look, I am not your financial advisor. I am simply looking at the public reports and historical data. There are 6 specific reasons why keeping that loan might be a strategic option worth considering for your future. We are going to look at why your mortgage might actually be paying you, and the liquidity trap that can bankrupt retirees who own their homes outright. It is time to replace that feeling of shame with real data. What if that monthly payment is actually a key to your liquidity? Therefore, we need to look at who is actually retiring with debt today.
Writing that final check to the bank feels good for a day. But what happens when you need that cash for an emergency? According to the CPBU, more Americans are entering retirement with mortgage debt than ever before. This is not because they are failing, it is because the old rules are breaking. Think about a retiree named John. He worked 40 years to pay off his home. He finally did it. But now his bank account is nearly empty. John is house rich, but cash poor. He has hundreds of thousands of dollars in equity, but that equity cannot buy groceries or pay for a hospital visit. If he needs money, he has to ask the bank for a loan all over again. This is the liquidity trap, and it is a dangerous place to be as costs rise.
But there is another danger, a tax trap involving the IRS that can cost you $40,000 or more if you pay off the house the wrong way. I will show you that exact trap in a few minutes. First, we have to talk about the invisible way your debt is actually shrinking every single month. To understand why your mortgage is actually a tool, look at the math of 2021. According to Fact 1, many homeowners locked in rates below 3% back then. If you are one of them, you are holding the cheapest money in American history. Take a second to realize this. The bank is actually losing value on your loan every month while you keep your cash. This happens because of inflation. According to Fact 2, long-term inflation often matches or even exceeds the cost of a low-interest mortgage. This means your $2,000 payment today will feel much smaller by 2035 because those future dollars will be worth less. Your debt is fixed, but the value of your home and the cost of everything else keeps rising. This is an inflation hedge. If your debt is cheap, why would you give up your expensive savings to kill it? Therefore, keeping that mortgage might be an investment worth looking at.
You were likely taught that debt is a monster you must kill. But in a high-return world, that monster can be a tool. Look at the spread. According to data from Vanguard and Morningstar, the long-term average return for the S&P 500 is often between 7 and 8%. Compare that to a mortgage rate of 3 or 4%. If you pay off the mortgage, you earn 3% by avoiding interest. But if you keep the cash in the market, you could be earning 7% or more. By keeping the loan, you are potentially pocketing the difference. This is why putting all your cash into your house is so risky. You lose the ability to let that money grow.
But there is a tax reality most people miss. Since 2017, the IRS standard deduction has increased significantly. According to Fact 3, many homeowners no longer get any extra tax benefit from their mortgage interest anyway. It is worth checking if you are actually receiving a tax break that you might not even be using. Coming up is the 15-second tax check you need to do. But you cannot just look at returns. You have to look at what the IRS takes when you pull money out. Think about Mary. She had $150,000 left on her mortgage. She decided to be responsible and withdrew the full amount from her traditional IRA to pay it off. Mary did not realize that the IRS views that withdrawal as ordinary income. According to Fact 6, a large withdrawal can instantly push you into a much higher tax bracket. Mary jumped from the 12% bracket all the way to 22%. She thought she was being responsible, but she paid thousands in taxes she could have avoided by keeping the loan. Then there is the opportunity cost. If Mary had left that money in the market, it could have doubled in 10 years. Instead, it is locked in the walls of her house, earning zero interest. Now that you see the math, how do you decide if your mortgage is fine? Therefore, one approach many people consider is using this 3-step checklist. First, check your interest rate. According to Fact 1, if your rate is under 4%, historically the math has often pointed toward keeping the loan. Second, look at your liquidity. Do you have 6 to 12 months of cash in the bank? If you do not, many experts suggest avoiding using your remaining savings to pay off the house. Third, consult a professional tax advisor. Everyone's tax bracket is different, so ask specifically about the tax impact of a large 401k or IRA withdrawal.
Finally, calculate the spread. If your investment return is higher than your mortgage rate, keeping the loan might offer more flexibility. You worked hard for your nest egg. Do not let old rules or social pressure take it away. If this math helped ease your mind, consider subscribing for more retirement analysis focused on facts, not fear. Many advisors suggest looking at your total portfolio, so please talk to a licensed professional about your specific situation.